Welcome back to this week's market update. Today is December 9th, 2024, Monday morning, and with that, we'll jump right in. It was a positive week for stocks with both the S&P 500 and the Nasdaq reaching new all-time highs, supported by some pretty strong employment numbers that we got later on in the week. As of Friday, December 6th, the Nasdaq Composite was up more than 3%, the S&P 500 up almost 1%, the Barclays Aggregate Bond Index just about flat for the week, and then the Dow Jones Industrial Average down 0.6% in the week. Now shifting gears into our economic data from last week, it was a big week for jobs numbers for the month of November. We saw the U.S. economy add 227,000 jobs in the U.S. in the month here. As you can see, it's a huge improvement from the disruptions that we had with the hurricane, as well as some union strikes in the month of October that led to this really weak number here. The unemployment rate rose slightly to 4.2%, still in a very healthy range, but up slightly from October. And then annual wage growth came in at 0.4% in the month and 4% when you look at it on an annualized basis. So pretty strong wage growth there, actually real wage growth when you account for what inflation has been running at. And with that, we will jump right into our second employment number of the week. Another important measure of labor market conditions, we get the ADP private payroll numbers, typically a day or two before the official employment report. It showed that private employers added 146,000 jobs in the month of November, with large employers driving much of that growth. Manufacturing posted its weakest numbers in job growth since the spring, while financial services, leisure, and hospitality also saw some softer hiring in the month. We also saw in this measure year-over-year pay gains improved, with job stayers seeing an average wage increase of 4.8% in the private sector, while those who changed jobs experienced about a 7.2% wage growth. So getting paid a little bit more when you jump jobs than if you were to stay at jobs and just get the annual raises. But overall, both numbers look pretty strong and are outpacing inflation. Moving along in our week, it was also the same week that we get the ISM indexes. So the manufacturing index continues to look quite bearish, while the services index looks to be expansionary. So in November, we saw it rise slightly to 48.4, so a little bit of an improvement from October, but it remains below that 50% level required to be bullish. So above 50% is a bullish reading, while below 50% is a bearish reading. This is the 8th month of contraction in the manufacturing sector consecutively, and it is the 24th month of contraction out of the last 25 months. So nearly 2 years now we've been in a manufacturing recession, as you could say, although the overall economy has been growing. The ISM also noted in their report that demand remains weak as companies finalize their plans for 2025, but they did benefit from the resolution of election-related uncertainties in November. Production execution eased in November as well, reflecting sluggish demands and weaker backlogs. They also noted in the report that although suppliers have capacity, with improving lead times, some product shortages have re-emerged. In contrast to the manufacturing sector, the service sector appears to continually be growing in the month of November here, coming in at 52.1 on that services PMI. Now, this is a slight decrease from October's numbers of 56. It's a very bullish reading there, but it does mark the 5th month of expansion in a row, and it is the 51st month out of the last 54 months since the COVID recession of expansion. So still a lot of positive momentum in the service sector. Breaking down November's PMI here, we did see slight decreases across all 4 components of the PMI, which include business activity, new orders, and employment and supplier deliveries. However, we saw 14 industries report growth in business activity, and 13 actually indicate expansion in new orders. So these are improvements from October. Overall, a lot of bullishness in the service sector, with the 12-month average still running well above 50 at 52.2. Last but not least, we saw consumer sentiment rise for the 5th consecutive month in December, climbing about 3% to reach its highest level in 7 months here. And within consumer sentiment, they noted two pretty important things here. We had one, a growing political divide between Democrats and Republicans. So, Republicans seeing their sentiment rise sharply in November and December, while Democrats had the opposite result, with Democratic sentiment falling sharply in November and December. And then on the other hand, we also saw a lot of consumers report concerns that prices of major purchases may rise in the upcoming months. So that drove a lot of economic growth, or at least reports of current economic activity. You can see here after the November election, we had quite a very high level of consumers wanting to buy durables ahead of these proposed tariffs that Trump may try to enact in January. So, interesting stuff here as we look at kind of the breakdowns of what has been driving consumer sentiment. And with that, that closes off our week of economic data. Thank you so much for tuning in to this week's market update, and we look forward to providing another update for you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.